Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice. Welcome to the Stock Spinoff Investing Podcast. I'm your host, Rich Howe, and today I am very excited to be talking to Dom D'Angelo of O'Keefe Stevens Advisory on Callaway Topgolf. Dom, thanks for taking some time.
Thanks, Rich. Happy to be here.
So, Dom, I would love to, before we get into the Callaway Topgolf thesis, I would love to hear a little bit about your background. But I guess before that, I want to say that you and I met this past year at Berkshire, which was a ton of fun. We met through mutual funds over steak dinner in Omaha at the Berkshire Hathaway annual meeting, and I think we're both going to be back there this year, which would be fun to do it again. But I heard you pitching a stock, and the write up or the pitch was extremely compelling. I was like, wow, this guy's smart. Want to stay in touch with this guy. And then fast forward to a couple months ago, I sent out an email with some spinoff links, and one of which was an email to a really good Value Investors Club write up on Callaway Topgolf. And you just emailed me back and you're like, oh, Rich, by the way, like I wrote that, thanks for sharing it. And I was like, okay, well, we need to talk because this is obviously a spinoff situation that is really interesting. And you're a smart guy. You've done a lot of good work. So we wanted to connect on it. But so that's the backstory for listeners. But before we get into the thesis, I would love to hear just a little bit more about your background. How did you get into the investment management business, the equity research business? What's your background? Did you always know that you wanted to be, picking stocks?
Yeah. So I grew up in Buffalo, New York. I think I bought my first stock when I was 11 or 12. And so I always had this investing bug. And I went to school for finance and economics. And they always say it's not what you know, it's who you know. And I got very lucky in that my neighbor is best friends with one of the owners at O'Keefe Stevens Advisory, where I am today. He said, hey, you should go talk with him. He's got a value investing mindset. Would be a really good connection. Went out, and that was in 2017. Stayed in touch throughout college, throughout my career. And one day they called me up and they said, hey, Dom, we're looking to hire an investment analyst. We already have you in mind. Would you, come out, interview, all that jazz? And turned out to be a really good fit. And now I've been here for coming up on 5 years. Amazing how time flies. My first job out of school was at a commercial real estate broker in Buffalo, was there for a year, but always wanted to get into the investing space. Got really fortunate and ended up in Columbus, Ohio at Ohio Public Employees Retirement System. Was there for 2 years, just covering mainly financials, and was a generalist. And then after that, got the offer here and have been at O'Keefe Stevens for coming up on 5 years. I'm currently the director of research, and we manage today about $550 million. We're long only, and it's primarily retirement assets that we have.
Yeah, I was going to say from reaching out cold email, meeting a neighbor to being director of research, that's a
Yeah.
pretty good trajectory. So
Yeah.
well done. And then,
Thanks.
so you grew up in upstate New York, and O'Keefe Stevens is it back home, kind of near where you grew up?
Yeah, it's in Rochester, New York, so it's an hour away. So it's far enough away where I'm not gonna have my parents coming out for dinner every day, but it's close enough to home that, if I ever need to be home, it's great.
That's amazing. And then in the RA business, so the more I look at the more RAs I look at, it seems like the typical model is to just invest in ETFs,
Yeah.
right? Because it's like, hey, what's the brain damage? It's hard enough to beat and it's kind of a smart approach. Like it's hard to beat the market. Most professional money managers don't beat the market. I think it's very rare to have an RA that's just focused on actually picking good, compelling stocks. So I guess what's the background there? It sounds like the founder was basically a stock picker, value investor guy. You're the same way. So is that the approach? So you basically manage client assets, mainly retirement assets, and you say, hey, we're basically going to we're going to try to beat the benchmark.
Yeah. So that is a lot of that is correct. We always say we do what we think is right. And, there are obviously clients that we turn away that say, hey, I just want the market. And we also have a financial planning side of the business as well that ties in really well. But some clients are not a fit and they just want the market and financial planning services. We, based on the way indexes are constructed, yes, they've done very well, but we think over the long term, a deep fundamental investing based investment plan is going to be the better approach over the long term. Obviously, you have volatility in anything, and that comes with a price, but it's sort of just the approach that makes the most sense to us. And I'm going to say the good part about it is we tend to find clients that are very like-minded, and it also allows us to pick our clients' brains on, hey, a lot of these are former retirees, or maybe they're still in the workforce. We have Constellation Brands here in Rochester, New York. That's maybe a stone's throw away from us. Like we have intel from our clients that maybe we otherwise wouldn't have. So it's a really good relationship that we have.
And we're supposed to be talking about Callaway Topgolf, but I have a lot this is just really interesting. So say I had, say I had $100,000 of retirement money that I wanted to bring to you guys. I don't know what your client minimum is, but do you guys have like a model portfolio that you say, okay, I mean, it's probably got to take into account risk tolerances and time horizon and all that stuff. But are you guys saying, hey, here are my 10 best ideas, 20 best ideas, 50 best ideas? Like, how do you think about kind of constructing a portfolio if somebody brings you, say, $100,000?
Yeah, so we have migrated over the past couple of years to what we call model portfolios. Those model portfolios, though, are going to uh, change based on what we view as the most attractive investments at the time. But we have our typical portfolio is anywhere from 25 to call it 45 securities. That number will range based on where you are in your career path, how much you have in assets, just a host of different factors. And the reason we do models is we've been a growing firm, and choosing individual securities at a certain time when an individual comes in, if you bring us $100,000 today, you're not going to say, hey, you can take a couple of years to invest that. You're giving the money because you think, hey, we can generate good risk adjusted returns. So we've migrated to a model portfolio because it's a little more seamless on the back end for us to invest capital versus handpicking individual stocks every time new money comes in. And then you can imagine that's backstory. That is actually how the firm was founded. But you can imagine that over time, maybe portfolios are a little too different than what your ideal scenario is. And so just a growing firm, more clients, it's just a very tedious task to then manage that portfolio. So we found model portfolios to be a little more seamless as we've grown.
That makes complete sense. Yeah, that I'm sure basically the vast majorities of RAs that have achieved any sort of scale take that approach because it makes a lot of sense. Okay, let's transition here to Callaway Topgolf. So maybe just talk about Callaway Topgolf at a high level, why you think it's interesting, and then we can dig in.
Yeah. So just full disclosure, clients of O'Keefe Stevens Advisory own shares of MODG, Topgolf Callaway. And so I'll just say backstory on why I think it's interesting is I've golfed for a long time now. I think I always look for industries and businesses where I think I have a competitive advantage versus what I'm going to say just traditional market participants may have. My Twitter feed is investing in golf. And so I think I'm very tuned in to what is going on in the market. And I'm trying to find ideas where if the thesis goes against me, I'm going to be one of the first individuals to know that the thesis is not going out or is not playing out as planned, and will be therefore one of the first to sell the stock because I have an information advantage. And then the other reason I thought Topgolf would be really good is there have been golf simulators that have popped up everywhere. My cousin opened one, and I thought it's a really interesting business model. And so they own a business called Top Tracer. It's basically found at driving ranges, and I've seen them popping up everywhere. Thought it was really interesting, the business model behind it. So wanted to do more research on that. The Topgolf side, it's an interesting business, but I always am worried when you have a business that is both has a business that has both high operating leverage and high financial leverage. And Topgolf is exactly that. They structure all of their Topgolf locations as leases, and then their operating leverage, if you've ever been to one, they may have anywhere from 60 to 100 bays. It's just a driving range that you hit balls out into different targets and you can play different games. And so that incremental customer that comes to a Topgolf is all basically all profit. And when money is basically free and the government is handing out money, people are not exactly concerned with how much money they're spending on leisure activities. Now that that helicopter money is basically gone, the Topgolf side of the business has struggled. I think over the past 8 to 9 quarters, Topgolf same venue sales have been declining. And the final point I'll make is one of the benefits of being in Rochester, New York, is it's not this, Dallas, Texas, or Nashville, Tennessee, growing, vibrant market. It's, older money. It's like a slow grower, maybe slow decliner. And when I hear companies are opening up a location in Rochester, I then start to think, okay, they are beyond their primary top markets. They are now in their second and third ring locations that you would open one up. And there was reports that a Topgolf was going to open just outside downtown Rochester, and I was thinking, they're at right around 100 locations. You're in Rochester. They said that their domestic TAM is somewhere around 250 locations. So you combine 8 quarters of declining same venue sales. We're opening up potentially a Topgolf in a second or third tier city. I was increasingly concerned that the Topgolf TAM and the business model maybe was more of a fad than anything. And I don't know what the longevity of these Topgolf venues are. And if we're already declining a couple years after some of these have been built, maybe the business model is not as great. So my whole thesis on the Topgolf Callaway side was I don't really want to own Topgolf. I think the Callaway club and ball and apparel business is much better. It's more economic resilient. It's typically skews higher earners. And so I thought if you separate the two businesses, the remaining company of the Callaway club ball apparel business looks like it's significantly less levered than what it appears today. And you've got some high quality assets that I think are significantly undervalued relative to what peers are trading at and just what I think they can earn over the next couple of years.
Okay, awesome. That's a great overview. And just to speak to your point about taking advantage of your location, I think the company that you were pitching at Berkshire was a company that is they sell salt
Yep.
on the road. They sell salt that you use to salt roads so that you if you have snowy winters, cars don't crash off the road. And I know you had some like very good in the weeds diligence on reasons why that business was really well positioned. So I can definitely speak to the you taking advantage of your location. And then okay, so talk to me a little bit about I mean I think the reason why this was so interesting, and I cover spinoff situations, and historically typically this was going to be a spinoff where the Topgolf business was going to be spun off. When I look at a spinoff transaction, typically the situations where the most value is unlocked is if it's a clean break, right? If it's like going to be like 100% spinoff, because then you can value the spinoff, you can value the RemainCo, and you can do the math and see if there's going to be a clear valuation unlock. And I think initially it was going to be a partial spinoff, and then that business was going to be monetized over time. And my thinking was that this was just going to be a situation where the stock was going to, yeah, you could do the sum of the parts math, but like, what's the catalyst for the stock to actually close the discount to its sum of the parts valuation? And so the recent news is that Topgolf is basically being sold, or at least a 60% stake is being sold to private equity. And what I think is so interesting about this is that if you look at Topgolf Callaway's enterprise value, according to Koyfin, it had like 5.5 or $6 billion enterprise value. And I remember I reached out to you and I was like, hey, they don't have that much debt. Is this a real enterprise value? And you're like, yeah, it is because they have all these lease obligation and deferred financing obligations that are tied to Topgolf that you really have to treat as debt. And so the cool thing about when I saw this transaction announced, the cool thing is they're selling a 60% stake. They're actually getting cash for it, which is pretty cool. And then they're getting rid of about $3 billion of enterprise value of like quote unquote debt. So talk to me about the recent announcement and why this is like a pretty interesting, catalyst for, and the stock has reacted. It initially traded down, but it's since recovered. So talk to me about this transaction and why it's a nice step towards unlocking value.
Yeah, so they are selling 60%, as you said, to Leonard Green Partners at a $1.1 billion valuation. They're getting 770 million roughly of net proceeds. And the best part is, as you said, they are deconsolidating the balance sheet. So all of the deemed landlord financing obligations, which are basically just operating leases, all the operating leases, and then all the financing leases, they are getting moved off of the RemainCo Callaway's balance sheet. And so then they're going to be left with 40% of the Topgolf business. The initial reaction of the sell-off when this transaction was announced, I was not unhappy, but I thought they were just going to either do the spin or 100% sale. I did not think this was going to be something that was in the cards. And I think there were probably some funds that were involved specifically for a pop on the stock if they announced a sale. And so back in, I believe it was July or August, the CEO of Topgolf, Artie Stars, stepped away to go over to Harley Davidson, and that delayed the spinoff, which was supposed to be, I believe, done in Q3 or Q4 of 2025, which pushed off into mid 2026. And then the thing that got me even more interested was on the last earnings call, they talked about still in the process of finding a CEO for the Topgolf business. And it had been 3, 4 months so far. And it sounded like they were still like in the middle of interviews, basically. And I don't think it takes 6 months to find a CEO of the business. So my thought was they're not actually interviewing CEOs. They are doing a hard go shop period, and they're going to find what offer is best on the table and then sell it. And then that's ended up what happened. And so now we're left with 40% of Topgolf at the RemainCo Callaway. And I think the one piece that has given me more comfort as I've stepped back and looked at it is Callaway is not going to be responsible for any capex associated with the expansion of Topgolf, which was my big fear was you would continue to take the good free cash flow from Callaway and put it towards Topgolf. That's not going to be the case. And then the other part of the transaction that I think is underappreciated is they own the Top Tracer business that I mentioned before. And that business, from everything I've gathered, is it's a sideshow for the management team. They don't talk about it. I've reached out to their IR team. They don't really understand the accounting of it. And it's a really good recurring sticky business that I think has significant pricing power that was not going to be unlocked by this existing management team. So sending it to Leonard Green, where they still have a 40% ownership stake, and I think Leonard Green is more likely to extract the full value of the Top Tracer business compared to the existing management team at Callaway. So the combination of no capex going towards the Topgolf, plus I think the Top Tracer business will get more attention. I think is where I come out as being a little more happy than the initial reaction.
That makes sense. And then the other thing to think about is in a former life, I was involved in the private equity world, and Leonard Green is a pretty good sponsor. So like they've had their mistakes, of course, as all private equity firms have, but they are focused on obviously making money for their investors and making care for themselves.
Yep.
So I love the idea of having them call the shots, 100% control, 60% control, have it not be a publicly traded business, and then have the RemainCo have a 40% ownership stake, and you really don't even have to assume any residual value to get excited about owning the RemainCo. So I think their transaction makes a ton of sense. So two quick questions. When is the transaction expected to close? And then I think, if I remember correctly, that management hinted in the press release that some of the capital that's been received from Leonard Green will be returned, or is might be returned to shareholders via maybe share buybacks or dividends. So I guess, when will the transaction close, and then what do you expect capital to be returned to shareholders?
Yeah, so they expect it to close in Q1 of 2026. So that was one of the reasons they said that they went with Leonard Green, is you've got basically surety that the transaction's going to close, and it's a quick close. Um, so that was critical to the reason they sold there. And then the capital return part is really interesting. You're going to go from a business that looks like it's highly levered to, you have the leases are gone, and they're going to have about 1.5 billion of gross debt, and net debt is going to be roughly zero once this transaction closes. And so I would expect them to pay off the convertible notes that they have. I believe those mature in 2026. And then they still have a term loan B that is about $1.2 billion. And that is a floating rate, 7.4% interest rate note that I think they will pay off a significant portion of. So you're going to go from, I think, 1.5 billion of, just call it gross corporate debt, probably down to somewhere around the 500 to 600 million dollars of debt, and then the remaining, call it 300 to 400 million dollars of cash that'll be available to buy back, dividend, whatever they want to do with the cash. That's what I think will be remaining. I suspect, based on where the stock is trading, based on where I think it's worth, that the management team should buy back stock quite a bit over the next, several quarters.
So you think it could be like 300, $400 million share repurchase authorization? That's kind of your
Correct.
best get.
That would be
Best
my
guess.
estimate. Yeah.
And then the market cap for RemainCo is, when I looked at it, it was like 2 billion, but maybe it's a little bit, I think it's appreciated since then. So maybe like 2.5 billion. So it's, roughly 10% of, or over 10% of kind of pro forma market cap.
Exactly. Yep.
Got it.
And
Okay.
and the good part is you've got a high interest rate debt that's, there's going to be a significant accretion to equity holders when they start paying off that debt, because you're eliminating, call it, a higher interest rate note.
That makes sense. So one name that I was involved in the past year, and I'm still involved and still own, is a company that was called IGT, which is a gaming business, and they rebranded to Brightstar. But I've noticed these patterns where, when part of the business is sold, and even if management indicates that, hey, we're going to return a bunch of cash to shareholders, for some reason investors just handicap that or discount that more than it should be. And then once the transaction actually closes, and they announce what they said they were going to do, the stock reacts very positively. So, perhaps that could be kind of like a near term catalyst. I know the stock has done very well over the past couple weeks anyway, but that could be a nice near term catalyst. Okay, so you think the stock's undervalued. Talk to me about RemainCo. So before we get into the valuation and what you think it's worth, talk to me about RemainCo. I know they make, Callaway golf balls, and I know they make apparel. So you're a golfer, would love to hear, your thoughts on, their business and the business outlook.
Yeah. So they have the Callaway golf club, so the driver irons. They've got a putter business that's called Odyssey. They're golf balls anywhere from Diablo to Chrome Tours. And then they've got an apparel business. They call it Active Lifestyle. That is Ogio and Travis Matthew. And then they also have Callaway apparel as well. So the club business in 2025, I think, is probably going to do somewhere around like 1.4 billion dollars of revenue. The apparel business, excluding Jack Wolfskin, which they sold earlier in the year, is probably going to do somewhere around 650 to 670 million dollars of revenue. So you've got a RemainCo business that's going to do somewhere around 2 billion, maybe a little north of 2 billion dollars in revenue. And this is I'm going to say it's a better business in that it's not as economically cyclical. Typically, there's a replacement cycle for golf clubs. Drivers, you may replace every 3 to 5 years. Irons are a little more expensive. You may replace those every 5 to 7 years. And then putters is basically, do you think the putter is the reason you're missing the putts? And so you've got that side of the business that
Which is
is,
100%. That's always the case, right? It's
that's
always the
right.
player's fault.
That's right. And so that's a good, you got that's a good business. The golf balls, if you're a bad golfer, you know you're buying more golf balls than a lower handicap golfer. And then the active lifestyle, the Travis Matthew brand is a high quality, like a premier clothing line, competes with the likes of like a Peter Millar or like a FootJoy Titleist brand apparel. So that side of the business is, I think, very underappreciated in that the Travis Matthew brand is not really well known in like the Northeast at least. And so I think there's a long runway for them to grow. And then the other thing that occurred this year is basically once out of every 8 years, Ping, TaylorMade, Titleist, and Callaway all launch a driver in the same year, and that happened to be 2025. So in 2026, 2027, 2028, you've got a little easier cycle in that there's not going to be as much competition on the racks for drivers or different clubs there.
Got it. Okay. And then talk to me about a little bit about golf. So it seems like number of rounds played for whatever reason since COVID, more people are interested in golf. I love golf. It's one of my favorite sports, but it takes, 5 hours to play 18 holes, 4 to 5 hours to play 18 holes. So it's a hard sport to play, but it seems like for whatever reason, people are getting more into golf. Is that the case? Is demand, number of rounds played per year continuing to grow?
It is, yeah. So the number of rounds played this year is up, I believe, low single digits, might be 1%. Um, but a lot of that is coming from COVID when it was like the only activity you could do because you couldn't go inside. So you had a influx of new participants play golf, and it appears that those customers, those golfers are sticking with the sport. And so part of the thesis was in 2021, 2022, you got a lot of new golfers. Typically, when you start a new sport, you're not going to go out and buy the hottest, the newest clubs. Because a driver these days is going to cost you $600. An iron set is going to cost you anywhere from $1,000 to $2,000, depending on what brand you go with. Wedges might cost you a couple $100, putter a couple $100. So all told, if you start golfing today, you could be spending north of $3,000 to get into the game. So instead of buying all that, typically you might go lower end, like beginner set or used clubs. And so I would think there's going to be a replacement cycle this year, 2026, 2027, as the golfers that came in to the sport in 21 and 22 say, hey, I like this sport. Let me go get fitted for clubs now that I know how to swing a golf club. And so that should accelerate revenue over the next couple of years as golfers that maybe didn't buy from Callaway at the beginning and maybe they bought like Top Flight or other cheaper brands now step up their purchases into Callaway. So you've got a replacement cycle, and then I don't know if you've noticed this, but more women appear to be getting into golf. I think the stigma of, hey, this is like a luxury sport typically played by men is going away, and I see more men, or I'm sorry, I see more women playing the sport, at least anecdotally, and then kids. I don't know if you've seen what's gone on like the YouTube golf side of the business, but there appears to be a younger demographic also getting into the game. And I think a lot of that is contributed from what's going on the YouTube golf side. It's not this, let me go hit the ball 300 yards and play this perfect round of golf. It's like people out there having fun, enjoying the game. And I think that's also driving new golfers into the sport.
That makes sense. Yeah, anecdotally, I've noticed the same thing. So my wife and her friends. So my wife as a parent, as a young parent, I don't know if you have any kids, but as a young parent, like obviously your time is limited. And she's like, my wife's into tennis and she would like to play golf at some point, but it's like I got to pick and choose my time or what she wants to focus on. But a lot of her friends are like, hey, let's take golf lessons. Let's take golf lessons at the local course. Let's get out, let's play. So I've definitely noticed that. And then I've also really tried to get my kids into golf too. There's a ton of programs. There's a PGA Junior League, which is a cool event whereby you can sign your kids up and they play in like a team format and they wear jerseys with their names on the back and their numbers on the back. And it's kind of like it's a scramble format where you
Yeah.
each take a shot and whoever has the best shot, you go to that ball. So yeah, I think the PGA is doing a good job of trying to get more people into it and make it more fun. And then things like Topgolf, where you can go and it's not going to be a 5 hour round.
Right.
You can play for a couple hours and make it more of a social event. Makes a ton of sense. So that all that stuff makes sense to me, and I'm seeing very similar trends anecdotally. What about from a valuation perspective? So I think the best peer is Acushnet, which I think, correct me if I'm wrong, I think owns the Titleist
Yep.
brand. So I think that's a good, probably pure play comp for RemainCo. So how are you thinking about, valuation for RemainCo once this transaction closes? Like what do you think is a fair value?
Yeah, so I think one of the things I look for in an idea is when does the stock and the business look different moving forward compared to if you were to run a screen looking backward. And so I think 2025 it's a messy year with you've got investment banking fees, you've got the sale of Jack Wolfskin. 2026 is going to look hairy as you start closing the Topgolf sale. So I have looked out to 2027 to kind of get a picture of where I think the cash goes in the debt pay down, share buybacks, and this is in 2027 is going to be the first clean year of no Topgolf, no Jack Wolfskin, just the pure play company that you will be getting moving forward. And when I look out there, I think one of the things that stood out to me was the significant bloat or growth in the unallocated corporate expense that they have. Back in like 2017, 2018, prior to all of their acquisitions, this figure was around 60 to 70 million dollars. And I think today it's closer to 180 million dollars. So I think when over the next couple of years, you're going to see some costs come out, primarily because there's a lot of one-time fees and other expenses that are going away from the business due to divestitures, or the sale. And so when I look out to 2027, I get the company generating around $1.30 in earnings, and that stems from you've got a significant portion of the debt, with a 7.4% interest rate, getting paid down. You've got the share buybacks, and I think you've got, call it low single digit to mid single digit growth, club revenue growth, along with right around mid single digit active lifestyle revenue growth. And combine all that, the company continues to expand margins. On paper, it doesn't look like they're doing that because of the tariff headwinds. But if you were to back out what they're paying in tariffs, gross margins on the club business are up 200 basis points, from a year ago. So I think the company is doing great things on the expense management side. I think they still have a ways to go, in terms of the opportunity. And I think you continue to get the replacement cycle of golf clubs. You get an easier launch schedule in 2026. And I think the last thing is one of the things I've tended to notice is when you have, call it two businesses, and one's I don't want to say a bad business, but one takes more focus from a management team, versus another segment. The Topgolf business, I suspect, took a lot of management's time away from the club ball apparel business. And if they're able to now go from a 50-50 time split on Topgolf and the club business to 100% on the club business and the apparel business, I suspect you're going to see some greater efficiencies derived from that. Maybe they've realized, hey, we've hired too much because I've had to focus so much more time on the Topgolf segment. Now that I'm more focused on the club business, hey, I don't need all these extra personnel, in the corporate office. They've also expanded their golf ball manufacturing facility. I think they spent about $100 million over the past decade, expanding that. So you've got that capex is not, I'm going to say not going to continue, but you got the DNA from that. So all told, I think I get to about $1.30 in earnings in 2027. I think Acushnet trades for north of 20 times earnings. I don't think Callaway RemainCo deserves a trade there because Titleist, their ball business, it's a more recurring business. So on that side, it's a better business. The Titleist side is a better business. But if you told me 16 times earnings on $1.30 of earnings, that gets you in a couple of years to right around a $20 stock, versus call it right around 12.50 today. So I think it's a good risk reward. And now that you're leverage is significantly less than it was in the past. I think the downside is far better. It's far less than what it was, just a year ago.
100%. No, I think that makes complete sense. And then just so I've looked at it on an EV to EBITDA basis, and I think right now, the biggest glaring difference is like on an EV to revenue basis. I think right now it trades, according to my math, RemainCo trades at about 1.1 times revenue, whereas Acushnet trades closer to 2 times revenue. So on an EV to revenue basis. So I think that's pretty compelling. I would love, and I think you kind of hinted at how you get there, but I guess when I was doing my initial analysis, I could see on an EV to EBITDA basis and an EV to revenue basis that there was a significant valuation discount versus a Acushnet, but I couldn't quite get to the price to earnings numbers that you were getting to. And the numbers that I was looking at is I think year to date through the first 9 months of this year, I think the business RemainCo has generated about 265 million of EBIT. There's 140 million of unallocated corporate expenses. So if you back that out, it gets you down to 125 million dollars of EBIT. And then there's I think a hundred and um let's oh no yeah, $125 million of EBIT if you back out the unallocated corporate expenses. So that gets you down to about $170 million of EBIT for RemainCo. Divide by 184 million shares and you get 91 cents of EBIT. That doesn't obviously factor in interest expenses or taxes. But the question for you is like how do you get to earnings an EPS number of $1.30 if I'm only getting to EBIT kind of on a recurring basis of 91 cents? And I'm thinking that the number's probably that unallocated corporate expense number is super bloated, and you're thinking that they're going to get some margin expansion, yes, but they're also going to be able to cut costs back significantly. Is that the right way to think about it?
Yeah, I would say that's correct. Yeah, I think the unallocated corporate expenses in 24 were 185 million, and they said that a lot of that was uh, Callaway, the club ball business. I still think there has to be a figure in there that is associated with the Topgolf business. They said when they were spinning it off or looking to spin off the Topgolf business that the RemainCo would have a $5 million net reduction in corporate costs from the spinoff, so synergies there. I think that corporate cost number over time is probably going to get closer to the mid 80 millions, maybe low 90 millions, because there's also the factor of they sold the Jack Wolfskin, get rid of the Topgolf business. There's tons of investment banking fees in there as well. So I think over time that number is going to come down significantly. And the other part of the business that we haven't talked about is they have a brand called OGO. It's a backpack, it's a golf travel case. They make golf bags as well. Chip Brewer, the CEO, was recently on the Jefferies conference, and I found it interesting that he started off the conference by saying, "Yeah, we have these great brands. We have Topgolf, we have Travis Matthew, we have the Callaway business," and he left off the OGO business. And maybe I read too much into it, but I think there is a non-zero chance they also sell that business because it's probably more comparable to what Jack Wolfskin is versus what a Travis Matthew is in a pure play apparel business. And they acquired the OGO brand, I believe back in 2017, 2018, for $75 million. They don't disclose what it's done. Maybe you can get 125 million for that brand. And then that accelerates again the share repurchase and lowers the corporate expenses as well. So that's kind of how I get to you get mid-single digit revenue growth, some margin expansion on the gross profit line, and then you take out some of the SG&A lines, and then you go from $1.5 billion of corporate debt at a average interest rate of, just make it easy, somewhere around 7% to $500 million of, call it, corporate debt, somewhere around there. Right now, they're single B rated by S&P. I think in a year or two, you're going to see them go from single B, that's on positive outlook, to probably investment grade would be my suspicion. And you go from a 7% interest rate on $500 million of debt, roughly, to maybe a 500 to a 5% interest rate on $500 million of debt. So that's another interest expense savings. Again, that's all accretive to equity holders. Combine that with a couple $100 million of share buybacks. I think the share count is going to decline, maybe 20-ish% over the next couple of years from the buybacks and the excess cash that they have today. And that's how I think you go from your figures to, a dollar 30 in earnings to where I am.
That makes sense. The thesis seems compelling. It's like a de-risk story. It's a changing story. You also have the near-term catalyst of this transaction closing, which I would imagine has very high certainty. And then you have the longer term upside situation with the catalyst for the buybacks and also just the pruning of the unallocated corporate expenses, the reduction in debt. So
Yeah.
seems super compelling. What do you think are some of the risks? Like, what if this investment case, if this didn't work in a couple of years, what do you think would be the big reason why it didn't play out?
Yeah, the management team does not have the greatest track record of acquisitions.
Hmm.
And you could say that a fear is they now have $1.5 billion of cash that they could go spend. Are they going to go out and try and acquire another brand? And they acquired Topgolf for it was they when they announced it, they used all stock. It was somewhere around a $2.1 billion valuation. I think once it closed, based on what the stock did, it closed somewhere around a $3.2 billion acquisition price, and now they sold it for 1.1 billion. They sold Jack Wolfskin at I don't know what the exact number is, but a loss compared to what they paid for it. So I think the management team, the track record that they have is not the greatest, and there should be some concerns if they're going to go out and make another acquisition. The only concern I have on sort of like the broader golf industry landscape is prior to COVID, uh, golf rounds, golfers, the number of golf courses, everything was generally on a downward trajectory. Um, I know golf courses were closing pretty regularly. And now that you've had a surge in the number of golfers, golf courses are relatively packed. To get a tee time to play 18 holes, the 18 holes goes from 4 hours on a normal Friday, Saturday, Sunday to I've spent time on a golf course north of 5 hours, 5.5 hours. And does that discourage people from playing because 4 hours is already a lot of time to spend away from the house? Now you're asking 5.5 hours to spend away. Does that start to eliminate the number of golfers because they just don't have that kind of time? Golf is a very expensive sport. Like I said before, I think it might be $3,000 to buy a new set. Where's the consumer today? Do they have the money to start playing? That's another factor. And the transaction closing, I think is more of a formality than anything. But you do have that remaining 40% stake, and does Leonard Green somehow manage it worse than the existing management team? And if Callaway wanted to, they could put money into the Topgolf business. Do they do that? That would be like your other negative risk that I could see.
Makes sense. What about, so do you think, so it seems like they've shared that, hey, we're going to get proceeds, we're going to return cash to shareholders. So it seems like they are not thinking about doing a big acquisition. Is that the sense that you get? Because that seems like when you mention that risk, yeah, that would not be good if they did another acquisition, just given their track record. So what gives you comfort to invest, despite that risk?
I think after two or three failed acquisitions, you would hope that the management team has kind of understood that they are just like not the right uh, individuals to do a roll-up story or an M&A strategy. And just based on where the stock is today, I, for them to get to a acquisition that is more accretive to shareholders than just buying back stock and the risk of integrating an acquisition, I just think the hurdle is much higher today than maybe where it was back in like 21, 22 when the stock was significantly higher. I think today, just the stock in the $12, $13 range, it's such an easy story to tell people, hey, we're just going to be share cannibals for the next 5 years, use all of the good free cash flow that the club business generates and just plow it back into shares. I think it's such a simple story to tell relative to the complex history that the company has. And I think they've kind of learned their lesson on that. One other thing I'll add real quick is the other interesting part was Leonard Green already owned 4% of Topgolf Callaway. And even after this transaction, they are still going to be 4% owners of the RemainCo Callaway business. The management team of Callaway has already disclosed, hey, expect us to hold Topgolf Callaway for 4 to 5, or sorry, hold Topgolf for 4 to 5 years because that's the average holding period of a private equity firm. Would not shock me if in a few years Leonard Green ended up making a full takeover offer for the RemainCo Callaway business, just based on that they already own 4%. They already own a lot of Topgolf. Basically, put the band back together, but with potentially better operators.
Makes complete sense, especially when you see the $180 million of unallocated corporate costs. It's like private
Yes,
equity is like, all right, I know how to handle that.
exactly.
Okay, well, Dom, it's been almost an hour, so I really appreciate you taking so much time out of your day to walk us through this investment case. So we're kind of wrapping up here, but I guess before we wrap up, any closing thoughts? I think really you've covered it all in terms of Topgolf Callaway, but any closing thoughts before we conclude?
The only thing I'd add is sort of like these two sort of like right tail events that could be positive for the RemainCo. Both are on the more political front. The current president, you got tariffs are always in the news. It's a headwind to Callaway's business. I believe it's around an $80 million headwind. They're going to be able to mitigate some of that. The president's favorite sport is golf. Is there any potential that Callaway and the golf club industry gets some relief from that? I don't know, but I'm going to say maybe possible. Or if they don't get any relief and tariffs remain in place, he's obviously talked about like these refund checks, 2000, whatever the number is. If you start giving people more money, I suspect a lot of golfers are going to use some sort of refund check to go out and buy new clubs. And again, that would just be a tailwind for Callaway. Right now, the issue is with on tariffs, are they going to raise prices on $600 drivers, which are very expensive already, to mitigate the cost of tariffs, or are they going to eat some of the margin? If you give people money, you're probably more likely to raise prices because people have extra disposable income. Those are two sort of like right tail events that I don't know what the probabilities are. I just know that they are there and would be a net, whichever way it spins. If tariffs go away, Callaway benefits. If tariffs remain and we get a refund check, then I think Callaway benefits. So I think on the one hand, they're a negative for the business, but if you look out a couple of years, could be a positive.
If I got a refund check, I think I would get a zero torque putter. I think
Yeah,
that would improve my golf game significantly. I think putting
yeah,
is my biggest area of weakness. Well, Dom, this has been awesome. Really appreciate you coming on and talking stocks. If people want to get in touch with you, learn how to invest with your firm, what's the best way to get in touch with you guys?
sure. I would say first, just email myself, Dominick at o'keefestevens.com. You can go to our o'keefestevens.com website. I have a Substack as well. It's at the Lion's Roar. Uh, our logo is a lion's. That's where that comes from. I would say those are the two best ways. And then we're on Twitter at OSA_Rochester, and always love to chat stocks with anyone.
I didn't know you had a Substack.
Yeah. Yeah, I don't post too frequently, but
Yep.
every now and then I'll put something out
I
there.
follow you on Twitter, and it was really helpful after the Callaway announcement just to get your live thoughts. So I
Yeah.
really recommend following you on Twitter. Well, Dom, thanks so much, man. Really appreciate you taking some time on a busy holiday month. And I am sure we will talk soon.
Awesome. Thanks, Rich.